What sort of property should this couple buy? Now, Rebecca and Jeremy are set to buy their first investment property, but what should they buy? Well, there are three main types of properties. You've got growth, yield, and lemons. Now, growth properties, they tend to increase in value faster, but their rental returns and cash flow just aren't as good. Yield properties, on the other hand, they give a better rental return and cash flow, but they don't go up in value quite as quickly. Then, of course, you've got lemons. These are properties that don't grow in value that fast, and they also don't have good rental returns. So what should Rebecca and Jeremy buy? Well, they're clearly not going to go for a lemon, so let's weigh up growth versus yield. Growth properties are homes like standalone houses and townhouses, generally in the main centres. They're the sorts of places that families or first home buyers want to own. Maybe something like this, which we've just recommended to an investor here at Opus Partners. It's a 2-bedroom, 2-bathroom townhouse, and it's also got a garage in a really nice area. Now, the traditional thinking is that owner-occupiers, people who buy homes to live in, are more emotional and so bid up the price when it comes time for you as the investor to sell. And you can imagine in 20 years' time, when this investor decides it's time to sell this property, a young couple, maybe with a child, might come along, buy this for their family to live in, perhaps as their first home. But from running the numbers on hundreds of properties here at Opus Partners, we also know that the rental returns on this sort of property won't be as good as a yield property. A yield property, on the other hand, it's more likely a dual key apartment, a room-by-room rental, maybe even a hotel room. Now, these generally provide better rental returns, but they don't grow in value quite as quickly. So let's look at the data. Here we've got the increases in value for houses and townhouses and also apartments in Auckland City for the last 20 odd years. And what you can see is there are times where houses and townhouses definitely increased in value much faster than apartments. And often the reason for this is that yield properties are specifically configured or put together to get more rent. And in doing that, they become more attractive for investors, less attractive for people who actually want to buy a property to live in. So take this dual key apartment just as an example. Now, we recommended this property to an investor a few years ago here at Opus Partners. Now, when you walk through your front door, you come to two more doors. You go into this door and you've got its own 1-bedroom apartment. You've got a kitchen, you've got a bathroom, you've got the bedroom, living, dining. Now, if you were to walk through the other door, you then have a self-contained studio apartment fit with its own bathroom and also a kitchen. Now, this property here has the same number of bedrooms, the same number of bathrooms as this townhouse that I just showed you before. But which one is a family going to want to buy to live in for themselves? Is it going to be the townhouse or is it going to be the dual key apartment? Well, it's probably going to be the townhouse, because why would a young couple with a child want to buy a place like this? Little Jimmy and Susie, they don't need their own studio apartment with a kitchen. A family wants a single dwelling. But if you were an investor, well, you could rent out this 1-bedroom apartment to a couple, and you could rent out this studio perhaps to a single person. That means 2 cents of rent, which means often a better cash flow for that property investor. So those are the two types. We've got growth, we've got yield, but which is better? So what makes more money for Rebecca and Jeremy? Is it going to be growth or yield? Well, let's say they had the option of purchasing 2 properties and they're both $750,000. They can either go for growth or they can go for yield. Now, what would the differences be? Well, your growth property is going to increase in value faster, and we usually forecast 5% here at Opus Partners. That yield property, we forecast it will increase in value about 3.5% per year. But of course, there's also cash flow. So in the first year, while interest rates are really high, an investor may need to top up a growth property by $400 a week. And that's because the rent isn't enough to cover all of the expenses. With yield properties, the cash flow is better, but it will still require a top up from the investor. It may be $200 a week, but these will likely go down as interest rates come down and rents increase. So let's talk about which one makes more money. If we think about the increase in value over 15 years, By the time that this growth property increases every year by 5%, in 15 years, the investor will have made, say, $810,000 through capital growth. The yield property, because it's not increasing as fast, the investor would have made a touch over $500,000. But the main point is that the growth property increased in value by $300,000 more than the yield property. But we also need to think about cash flow. Now, when we model out cash flow over 15 years, your growth property may need to be topped up by about $75,000 over that 15-year period. With the yield property, you might have positive cash flow of $75,000, again, over 15 years. So in that instance, the yield property, in terms of cash flow, made $150K more than the growth property. Now, to understand which is better, we've got to add the two together. Now, if we look at the total wealth generated by the growth property, it's a touch under $750,000. Compare that to the yield property, which is a touch under $600,000. The most important part to realize is that the growth property made about $150,000 more than the yield property over that 15-year period. So if you want to make the most money, generally speaking, go for growth. But if cash flow is more important to you, go for yield properties. And if you like learning about property in this number-focused way, make sure you subscribe to our YouTube channel. We release new videos every Monday and Wednesday. And if you already do subscribe, you probably already know what Rebecca and Jeremy should do. Because they are looking for their first investment property and they are a long way away from retirement, generally they'd go and buy a growth property. It will likely increase in value faster, and that's going to create that nest egg for their retirement. But once they get to retirement, they might decide to sell that growth property, cash in their KiwiSaver, and use the money to buy a yield property. Now, why would they do that? Well, they can then live off the rental income in retirement, and that's called the golden goose strategy. And if you want help implementing that strategy and investing in property to create a passive income for your retirement, check out our website, opuspartners.co.nz. We help regular Kiwis grow their wealth through new build investment properties.